Good morning and welcome to Economy and Markets on the Business Day TV, where we give you a comprehensive insight into the economy as well as the markets. On the show this morning, we're starting off with a conversation around the capital gains tax that was recently announced by Mr. Taiwo Uyedele. He announced that in October, and he announced that was 2 weeks ago, on October the 1st or 2nd, where he talked about the fact that if institutional investors were trying to, whatever gains that they made on selling off their stocks in the Nigerian exchange, there was going to be a 30% capital gains tax. For context, there used to be a 10% capital gains tax in the past, but however, this was seldom ever enforced. This was seldomly enforced, but now, from January the 1st, we'll probably be seeing an enforcement of an incredible 30%. And it's been generating quite a buzz in the market. It's been generating quite a buzz in the economy, because people are like, we basically have stabilized our currency off the backs of foreign portfolio investors that have come into the market. In the past 2 years, they've brought in tons of money into the market. The equities market has seen a surge in foreign participation, even though it still lags domestic participation. There's been at least significant surge compared to what we used to have in 2022, 2021. And to bring a little bit of perspective and context to all of this, we have Dr. Ayodeji Ebo, who is the managing director and the chief business officer of Optimus by AfriInvest. He's going to be helping us understand the entire context and understand and also bring his personal perspective into it. Good morning, Dr. Ayodeji.
Yeah, good morning. It's great to be here.
Yes. So first things first, I really want to get your take on it. How would you summarize the government rationale for imposing this 30% capital gains tax? We'll go on a break, and when we're back, I'm sure before the break, we were on the show with Dr. Ayodeji Ebo, who is the managing director of Optimus by AfriInvest, and our conversation was around the 30% capital gains tax for institutional investors. So, I was asking a question, Doctor. The question is, how would you summarize the government's rationale to come up with this particular tax? What do you think is behind what do you think is the rationale? What do you think is the thought process behind this increment in the capital gains tax?
So I think the first thing is that is the drive for revenue that must have informed this. But secondly, let's not forget that the uh, government is also trying to make it progressive. So trying to tax the rich to fund the poor. So you would also observe that across beyond the CGT, which is the capital gain tax, it's mostly high income earners that it affects. There's a threshold that protects, in quotes, the masses. So that's what I feel is that drive for revenue. When you look at the budget, there continue to be significant gap because the rate at which the expenditure is increasing is significantly higher than the rate at which our revenue is improving. Thanks last year to the FX devaluation that increased the oil revenue in naira terms, but there's been a bit of flattishness or stability in the exchange rate, which is positive. But to the government, to them, the jump in revenue is no longer there. So there's a drive to see how they want to increase revenue for them to be able to meet up with the target revenue from the budget, especially the non-oil service sector.
Okay. So in your view, don't you think that 30% is a bit too, is it excessive, or do you think within the Nigerian context it is okay?
No, I won't say it is okay. We're just recovering from a lot of the policy shocks from FX depreciation from high inflation rates, and you also look at high petroleum product prices, which has impacted on everything. So now with the new burden of having 30% on your profit is significant. I would have thought that it can be graduated because even at the 10%, it wasn't enforced. So a lot of investors were not even used to it. So it's almost like from zero, you have not been paying before. Now you are asked to pay 30%. If you make, based on the threshold, which I know we'll still get to, if you make above that, you imagine you made 10 million above that threshold
That
and you
threshold.
have to pay 3 million. This is 3 million that could have been used for other productive activities that you're also paying to the government. But meanwhile, most times there's still a trust deficit when we talk about tax collection in Nigeria. What are the things? Because when I speak with people, that the little they are even collecting, what are the benefits that we are generating from that? So those are some of the thoughts that will be in the minds of Nigerians. What are the benefits? So now that I'll be paying this huge amount of tax, what should I expect? And what I think from my own perspective is that with this new additional tax, it can be tied to projects. Like we normally see the Sukuk bond that
Yes.
you are passing through a particular road, you see Sukuk 4, Sukuk 5 built by that particular fund. So if Nigerians begin to see this particular major road is built by additional revenue from tax, then people will now be encouraged to even submit themselves genuinely to the payment of tax. So that's what I think it's really going to impact on disposable income, especially for the high end uh, income earners. Because when you see the way Nigeria has been structured, you may be earning more, but the dependence that you have as you grow higher is also very significant. So it's not like because you are there, you are just enjoying the money or the revenue or income, if I put it that way, that you're earning alone. There's always a lot of dependents that would come, requests that will come that you also need to fund. So this is reducing that disposable income, available income, for instance, may also impact on even the masses that a lot of the high income earners are supporting, given the reduction in expected revenue.
The one question I have is around the fact that, so when I look at the rate of, you look at um the division between retail investors, institutional investors, especially this year, we discover that more of the inflows have come from institutional investors. In fact, they, at some point, I think they contribute their participation. They basically run the market in a way, and there's more inflow from their part than there was outflow. Meanwhile, on the side of the retail investors, there was more outflow than there was inflow. That means retail investors are basically capitalizing on the liquidity that institutional investors have placed in. The question I have is, do you think that the government or the tax reform committee put this particular context into view before they came up with this policy? Do you think that they really observed that, okay, these institutional investors are contributing more than they are probably taking out from the market before they went ahead with this particular tax?
No, I would say that uh, this may not have been considered, but I always know that policies, when you choose policies at times, is also subject to improvement
Okay.
because, like you rightly said, the volume or the value of transactions carried out by institutional investor very significant, over 50 or 60%, if I'm not mixing up the numbers. That is going to now very discourage them on investment because you need to factor in that if you think that you are making 20%, you have to discount that 20% by the 30% CGT that you will pay as a company because it has increased from 10% now to to 30%. So you need to factor that. So you can't just get excited that you are making money. It means that you also have to factor in the return. So the expected return for an investor, especially additional investor, will now be higher, because if I'm going to invest in her market and I would have to still pay 30%,
30%
does it
tax.
make sense to just stay in fixed income or stay in other form of investment that I would, even if I generate 15% and what I have to pay is just 10% withholding tax? Am I better off than going to make return of 20% and I have to, by the time you discount that 20% by 30%, you would see that the return has reduced significantly.
Your returns will now be, so the question I have is around the enforcement now. Like you said earlier, the 10% wasn't really enforced. But do you think now, because a lot of things are kicking off January 1, when it comes to taxes, there's been a lot of buzz on the street. Do you think this is one of them that would be enforced starting January 1?
Yes, I think this would be enforced because even to the government, there's incentive to enforce it. And to the tax consultants that also work with government, there's also an incentive. It's based on what they're able to recover that they are also paid. So we would see, what we would see is typically they would pally the CSCS, for instance, to get data. So the market operators to get the data on transactions. And on the back of that, they would write to investors. So what investors need to do is they need to always keep records now, especially for the high-end investors. Just to put it into perspective, before I start talking, the threshold. So when we talk about individuals that used to pay 10% have now been increased to 30%. But there's a threshold. The rate at which tax will be applied, the tax rate that will be applied rather, will be based on your income level. So we know that 800, for those that earn 800,000 naira and below, are exempt from tax. But by the time they look at your income and they had whatever other, your salary and other income together, if it's above 800%, depending on where you fall, it is the same tax rate that will be applied. So some people, if the normal tax you are paying as a personal income tax is 21%, it is that same 21% that will be applied to your profit from the shares. But it's also good to note that the threshold before it is applicable is that you must have either crossed the 150 million threshold,
Okay.
or you are also made profit of 10 million. So if you make above 10 million, it means that you would pay 30% of that. That's 3 million to the government, and your net profit becomes 7 million. But if you don't hit that threshold, then you will not be liable to pay tax. But for company, company income tax is 30%. So what
Yes.
has been done is to harmonize it, that when you are calculating, before you calculate your company income tax, your gains too would have been added in your top line. And at the end of the day, by the time the 30% will be deducted, the 30% would be the same, would have also impacted on the gains you made from your sale of assets, sale of shares, and other related assets. So that's even the way it would work. So I believe that it's going to be a disincentive for investors. Investors will need to make more return at that level. Yes, investors also now need to be smart. They need to get consultants. There are ways that you can reduce what you pay. So if I'm looking at my portfolio, for instance, within a year, if I've already hit the 150 million threshold and I'm supposed to pay tax, and I'm carrying some underperforming stocks, for instance, rather than continue to keep those stocks in my portfolio, and pay money to the government, I may crystallize some losses to reduce what I will pay as tax. Also, you are also allowed, the relief you get is you're also allowed to reinvest. The portion that is reinvested is also exempted from paying capital gain tax. So investors need to now be aware on what we call tax planning. You can't, as you are selling, you have to keep your records. You have to know when you have the gains that you are making. You have to see if you are about to hit the threshold. What do you want to do? Do you still want to just keep your stock, or do you want to sell more to stay below that threshold? So there's a lot that now thinking that a strategy that now has to go in, which is not going to be convenient for investors. We talk about when you get to the foreign investors, for instance, some of them would have to pay double tax. So
Yes.
what is the incentive for them to now invest? You make $1 million and you have to pay $3 million to the government. Then you get to your country, whatever tax is also applicable on those profits will also be paid. So by the time they look at what point will they break even? At what point will it make sense when you compare it? Then I was saying that even if you make 20% in the stock market and you multiply it by, discount it by the 30%, it means your net return will be around 14%. Does it make more sense to just invest in net fixed income investment at 15%? Those are some of the considerations that
Hmm.
investors will have to
So,
look at.
doctor, for the constraint of time, you've given us quite a lecture on this particular subject. It's the question I want to have now. You are saying some things that would preempt my next question. Do you think that there will be a lot of sell-offs because now we are talking about the fact that companies will probably have to crystallize their holdings of underperforming stocks. So that means, in your opinion, do you think that we should be anticipating a sell-off by institutional investors in the coming weeks, say before the end of this year?
Yes, I think that would be done because investors' effective date is 1st of January 2026. So investors who want to enjoy whatever gains they've made this year will not be only 10% will be applied to it if it's going to be enforced, because that is already in existence. It is the new 30% that the government is trying to
And
reinforce.
will this not affect our ranking? Basically, our market is, if you look at the best performing markets in Africa for this year, I think we are, in terms of USD returns, we are number 5 in the number. Will policies like this not affect our ability to compete as a destination for portfolio investments, especially among our peers in the emerging market and in the frontier markets? Don't you? It's
Definitely is going to affect the attractiveness, like I mentioned, of our market, because your expected return will now be higher. Because what concerns investor is the net return. What do you actually make at the end of the day if you invest in this country? So I feel that given a lot of the debate and review going on, we may see maybe an exemption or a reduction in this capital gain tax for
okay.
foreign investors, because even when we look at the data, yes, most inflows are coming into fixed income investments,
Spaces.
but there's also a need for us to get for FPIs in equities that is significant, and they would work together, I think, with the coordinating minister, discussing also with the tax authorities as well as even the CBN. There's a need to harmonize their objective such that we don't scare away or discourage foreign portfolio investors. So there's a lot that it's 20% increase is significant. And it's so if before you're investing for 10% yield because of dividend on a pessimistic case, you look at based on dividend yield of 10%. It means on a net basis, if you belong to the high net worth individual rather, yeah, you means that your net yield will be about 7%. So those are some of the considerations that you have to make when you're making any investment decision from 2026.
Okay, thank you so much for your time on the show, Dr. Ayodiji. It's been a very insightful session with you.
Always my pleasure. Thank you for having me.
Thank you so much. After the break, we are going to be returning with business news making the rounds as well as updates from the market from last week. Stay with us. Welcome back to Economy and Markets on Business Day TV. We're going on to business news making the rounds. We're starting off with news of Aliko Dangote gaining almost $500 million during the week as the bullish run in the NGX propelled the Dangote Cement and NASCON stocks. So Africa's richest man, Aliko Dangote, added $497 million to his net worth in the week ending October 10. This is following a strong performance by his listed companies on the Nigerian exchange. Data from the Bloomberg Billionaires Index showed that Dangote's wealth rose from $29.1 billion to $29.6 billion within the week, driven mainly by gains in Dangote Cement PLC, where he holds an 87.45% stake. Dangote Cement share price climbed 9.5% during the week, translating to around $497.3 million in added wealth to Aliko Dangote. However, the sugar refinery saw a 1.3% decline during the week, reducing its holdings by just around $4.776 million. This loss was offset by a $4.52 million gain from NASCON Allied Industries, which recorded an uptick during the week. The overall performance underscores how closely Dangote's wealth is tied to Nigeria's stock market, especially the cement sector. So far in 2025, Dangote's fortune has grown by $1.5 billion, reflecting the NGX's bullish run. The rally has been supported by improved investor confidence, stronger corporate earnings, and the central bank's effort to stabilize the naira. Bloomberg ranks Dangote as the world's 76th richest man with assets spanning cement, sugar, salt, fertilizer, and oil refining, highlighting his central role in Nigeria's industrial and market growth. Then we'll move on to the news of Nigeria's equities deal for the first 8 months of the year. The value of equities deal traded on the Nigerian exchange surged to 6.92 trillion in the first 8 months of 2025. This is the highest in 18 years. The figure more than doubles the 3.47 trillion recorded for the entire year of 2024, reflecting rising investor confidence in the local bourse. Foreign investors accounted for 1.45 trillion or 21%, while domestic investors dominated with 5.46 trillion or 79%. Monthly data shows steady growth with trading values peaking at 1.815 trillion in July. A financial analyst, Abiola Razak, said the recent surge in market activity reflects improved liquidity across Nigeria's capital market. He highlighted that retail investors accounted for a third of domestic trade, signaling a renewed appetite for equities. According to Razak, this strong interest from local investors may be fueled by the Nigeria's exchange 5 consecutive years of positive run, with the NGX All-Share Index outperforming fixed income investments despite persistently high interest rates. Razak added that technology-driven platform and improved customer service have boosted retail participation. As FX stability returns, speculative capital previously held in foreign assets is being redirected to equities, supporting fund inflows. Institutional investors, including pension managers, have also increased equity allocation. The NGX report shows foreign inflows of 407.87 billion and outflows of 748.23 billion, while domestic retail and institutional trade reached 2.332 trillion and 3.13 trillion respectively. Analysts expect a slightly bullish market ahead of Q3 earnings, with sentiment driven by results, dividend guidance, and macroeconomic signals. China is warning the United States of countermeasures as Trump's 100% tariff threat ignites new trade clash. China has warned that it will take countermeasures if the US President Donald Trump follows through on his threat to impose a 100% tariff on Chinese goods. He's accusing Washington of hypocrisy and double standards as trade tensions flare again. In a statement on Sunday, Beijing defended its decision to tighten export control on rare earth metals, calling US actions provocative and damaging. The Ministry of Commerce said the move was in response to new US measures introduced after trade talks in Madrid last month. Trump announced that the tariffs will take effect November 1, describing China's export restrictions as surprising and very hostile. Beijing fired back, saying the US had overstretched the concept of national security and adopted discriminatory practices against China. China's stance is consistent. We do not want a tariff war, but we are not afraid of one, the ministry said. Rare earth key minerals are used in smartphones, electric vehicles, and defense systems, and they have become central to the dispute. China's tighter controls rattled global markets, while Trump accused Beijing of trying to hold the world captive. Analysts warn that prolonged tensions could slow global growth. Despite the harsh rhetorics, both sides say they remain open to dialogue ahead of a possible Trump-Xi meeting later this month. After the break, we'll return with updates from the market from last week. Stay with us. Welcome back. We're moving on to market updates. The NGX closed last week on a positive note as the bullish sentiment continued to drive gains across key sectors. Let's look at what the market is saying. The all-share index advanced by 54 basis points, 0.54 percentage points, to hit a new all-time high, 146,988.04 points. Based on Friday's performance, it has brought we now have a year-to-date return of 42.81%. The market is riding slowly to a 50% return at the end of the year. Market activity was robust, quite robust. 386.57 million shares traded in deals worth around 11.26 billion, while the market capitalization rose to 93.3 trillion naira. Dangote Cement led the gainers chart on Friday with a 6.48% gain to close at a share price of 575 naira per share. It was followed by NEM Insurance. NEM Insurance gained 5.23% to close at a share price of 29 naira 15 kobo. Jais Bank gained 4.65% to close at the share price of 4 naira 50 kobo. FTN Cocoa Processors gained 3.57% to close at the share price of 5 naira 80 kobo. Then CWG Group also was a significant gainer with 3.46% to close at the share price of 17 naira 95 kobo. And on the flip side, we see Union Home Real Estate Insurance Trust down 9.98% to close at the share price of 51 naira 85 kobo. Maya PLC, the paint maker, down by 9.85% to close at the share price of 15 naira 10 kobo. Sterling Holdco down by 9.58% to close at the share price of 7 naira 55 kobo. Cornerstone Insurance down 6.90% to close at a share price of 6 naira 21 kobo. Then eTransact International down 6.25% to hit a share price of 15 naira. And let's look at market activity for Friday. Fidelity Bank was the top traded stock of Friday, 47.342 million shares in deals worth about 959.3 million naira. They were followed by Champs, 38.451 million shares in deals worth around 169.8 million naira. Japal Gold, the mining company, the dredging company, mining company, basically 21.843 million shares in those worth around 56 million naira. Zenith Bank also 18.22 million shares traded in deals worth about 1.26 billion, 1.259 billion naira. FCMB Group 18.143 million shares in deals worth around 195.2 million naira. Let's look at the weekly market report. During the week, the all-share index appreciated by 2.37% to hit a new all-time high. This is the best week performance we've seen since August. Top gainers for the week: Sovereign Trust Insurance up by 16.73% in 1 week to hit 3 naira 21 kobo. Umatech Ventures up by 12.3% to hit 1.37 naira. AXA Mansard up 11.81% to hit a share price of 16 naira 10 kobo. 16 naira 10 kobo. Champs 11.69% during the week. Then Unicel Interlinked made it to the top gainers for last week. It also made it to the top gainers for last week. It made it to the top gainers for 2 weeks ago. It also made it to the top gainers for last week. Our top losers for last week: Living Trust Mortgage Bank, down by 14.6% to close at the share price of 520 kobo. Nimet International Pharmaceutical, down by almost 11% to hit a share price of 6 naira and 1 kobo. Union Home Rights, down by 9.98%. The gains, the losses were recorded all throughout Friday, then to hit a share price of 51 naira 85 kobo. Maya PLC, down 9.85% during the week, just on Friday, to close at the share price of 15 naira 10 kobo. Then Julie PLC, also down by 9.6% on Friday, to hit a share price of 8 naira 95 kobo. In terms of sectoral performances, it was a mix, as we saw the banking index down by 41 basis points. However, the insurance index was up by 3.69%. Consumer goods up by 83 basis points. Oil and gas up by 2.9%, and the NGX industrial goods index also up by 4.23%, especially driven by Dangote's Friday performance. In the global markets, there was a wipe off of almost $2 trillion in value on Friday, as we saw from Dow Jones to Nasdaq to S&P 500, all recorded significant losses. This is off the backs of renewed trade tensions between US and China. Dow Jones down by 1.9% on Friday. S&P index, also S&P 500, down by 2.71% on Friday, and the Nasdaq Composite also down by 3.56%. In Asia on Friday, we also saw significant the renewed trade tensions also had its way in Asia. We saw Nikkei 225 down by 1.01%, Kospi index down by 1.73%, and in Hong Kong also down by 1.73%. On Monday, the trend continued, as we saw Hong Kong's Hang Seng index still drop 2.04% on Monday, while in mainland China, the CSI 300 down slipped by 0.5%. This is while the market is going down, the currency is going up. The currency in China, the Chinese currency, is strengthening against the dollar. Now let's look at the European index. What happened in the US also snowballed into Europe. We saw the FTSE down by 86 basis points, the CAC 40 down by 1.53%, and the DAX index down by 1.50%. And on the currency side, the naira strengthened against all the major currencies. Last week, we saw a strengthening of the naira. Against the USD, is 1,462 naira to the USD. Euros 1,699 naira to the euros, and the British pounds 1,953 naira to the British pounds. And that's all we can take on economy and market for today. Thank you for staying with us. I'm your host, David Olujimi.